Hey everyone, welcome back to the channel. If you've been watching the silver market lately, you know we've just witnessed one of the most dramatic episodes in precious metals history. Silver hit an all-time high near $120 per ounce in late January 2026, only to crash by nearly 50% in a matter of days. Today we're sitting around $78 per ounce, and the big question on everyone's mind is simple: what now? More importantly, which silver stocks should we be watching as this market finds its footing? Before we dive in, I want to be clear about something. This isn't investment advice. I'm sharing data, analysis, and perspectives to help you make informed decisions. Always do your own research and consider consulting with a financial advisor before making any investment decisions. Now, let's talk about what just happened and where we're headed. The silver crash of 2026 will be studied for years to come. We saw prices rocket from around $32 at the start of 2025 to that stunning peak above $118 in January. Then came the sell-off. U.S. Treasury Secretary Scott Bessent attributed the volatility to what he called a speculative blow-off driven by Chinese traders. The Chicago Mercantile Exchange didn't sit idle either. They increased margin requirements on silver contracts from 11% to 15% as prices hit record highs. For anyone trading on leverage, that was a death sentence. Forced liquidations cascaded through the market, creating a feedback loop that accelerated the decline. But here's what's fascinating. Despite losing nearly 50% from its peak, silver is still up 162% compared to where it was a year ago. Think about that for a second. Even after this brutal correction, we're looking at gains that most investors would celebrate in any other asset class. So what does this mean for silver mining stocks? Well, that's where things get really interesting, and that's exactly why we're here today. The relationship between silver prices and mining stocks isn't always straightforward. In fact, industry experts have been pointing out a significant lag. As of early February, while silver was trading between $70 and $80 per ounce, many silver mining stocks hadn't caught up to the metal's performance. Why? According to market analysts, valuation models for these stocks are still factoring in silver prices around $25 to $30 per ounce, even though the average price last quarter was around $70. They essentially need to be revalued, and that hasn't happened yet. This creates what some are calling a catch-up opportunity, and that's exactly what makes this moment so compelling for investors looking at mining stocks. Let's talk about the 3 silver stocks that deserve your attention right now. I've analyzed current market data, production figures, financial performance, and strategic positioning to identify companies that stand out after this market shakeup. First up is First Majestic Silver, trading under the ticker symbol AG on both the New York Stock Exchange and Toronto Stock Exchange. This is one of the purest plays on silver you can find in the mining sector. The company derives an industry-leading 57% of its revenue from silver, which means when silver prices move, First Majestic feels it more than almost any other company. As of February 14th, the stock was trading around $23, and analysts have an average 12-month price target of $23.75, suggesting modest upside from current levels. But here's what makes First Majestic particularly interesting right now. 2025 was a transformational year for this company. They produced a record 15.4 million ounces of silver, representing an 84% increase from the previous year. That's not a typo. 84% growth. Much of this came from their January 2025 acquisition of Gatos Silver for $970 million, which added the Los Gatos mine to their portfolio. The company operates 4 underground mines in Mexico, and they've made significant operational improvements. Their San Dimas mine saw production increase by 19%, and they discovered the high-grade Santo Niño vein at Santa Elena, located approximately 900 meters from their processing plant. Over the past year, First Majestic stock has returned over 300%, outperforming other silver stocks by 35 percentage points. That's exceptional performance, but what matters now is what comes next. The company has a strong financial position that allows them to invest millions of dollars each year in finding and developing new silver mines. They also operate First Mint, a minting facility that produces silver bars, ingots, coins, and medallions sold directly to the public, providing an additional revenue stream that most miners don't have. The company focuses primarily on Mexico because it produces more silver than any other country in the world. However, this geographic concentration also creates risk. Mexican mining operations face regulatory uncertainties, labor considerations, and political factors that investors need to monitor. But for those seeking pure exposure to silver prices with a company that has proven operational excellence and growth trajectory, First Majestic deserves serious consideration. Next, we have Pan American Silver, trading as PAS on both the NYSE and TSX. This company bills itself as the world's premier silver mining company, and by market capitalization and production volume, they have a strong case. Pan American has grown through strategic acquisitions, and their most recent major deal closed in 2025 when they acquired Mag Silver for $2.1 billion. This gave them a stake in the large-scale, high-grade Juanicipio silver mine, one of the richest silver deposits currently in production. Pan American operates 10 producing silver and gold mines throughout North and South America. Their asset base includes some truly impressive numbers: 452 million ounces of silver in reserves and 6.3 million ounces of gold. In the fourth quarter of 2025 alone, they produced a record 7.3 million ounces of silver. For the full year, attributable silver production reached 22.8 million ounces, exceeding their updated annual guidance. What makes Pan American particularly attractive from an investment standpoint is their diversification. While they're primarily a silver company, they also produce significant amounts of gold, zinc, and lead. This diversification provides a buffer against volatility in any single metal's price. The company generates substantial free cash flow that management uses to fund growth projects while returning capital to shareholders through dividends and share buybacks. Their dividend policy is particularly interesting because it's tied directly to the price of silver, meaning as silver prices remain elevated, shareholders benefit through increased distributions. From a financial flexibility standpoint, Pan American has one of the strongest balance sheets in the sector. This allows them to weather market volatility, invest in exploration and development, and potentially make additional strategic acquisitions if opportunities arise. The stock has performed well, but many analysts believe it's still undervalued relative to the company's asset base and production profile. At current silver prices, Pan American is generating margins that would have seemed impossible just 2 years ago, and if silver stabilizes in the $70 to $85 range, this company is positioned to deliver exceptional returns. The third stock to watch is Wheaton Precious Metals, ticker symbol WPM. Now this one's a bit different from the first two, and that difference might be exactly what some investors need right now. Wheaton isn't a traditional mining company, they're what's called a streaming company. Here's how it works. Wheaton provides upfront financing to mining companies in exchange for the right to purchase a percentage of the metals produced from their mines at a predetermined, below-market price. It's a brilliant business model that provides exposure to precious metals production without the operational risks and capital intensity of actually running mines. As of the latest data, Wheaton was trading around $145 per share, up nearly 5%. The stock hit an all-time high of $156 on January 28th, right as the silver market peaked. The company has streaming agreements on 18 operating mines and 28 development projects. For 2026, they're forecasting attributable production between 18.5 to 20.5 million ounces of silver and 325,000 to 370,000 ounces of gold. What makes Wheaton so appealing is their margin structure. 93% of their attributable production comes from assets in the lowest half of their respective cost curves. In simple terms, they're buying from the cheapest producers, which means their profit margins expand dramatically when metal prices rise. In the third quarter of 2024, they reported revenue of $308 million and operating cash flow of $254 million. Their balance sheet is pristine, $694 million in cash as of September 30th, 2024, and zero debt. That's not a typo, zero debt. For investors who want exposure to silver's upside but are concerned about operational risks, mine accidents, labor disputes, or cost overruns, Wheaton offers a compelling alternative. Their dividend is tied to their overall financial performance, and at current metal prices, that performance is exceptional. The streaming model provides natural leverage to metal prices while avoiding the pitfalls that can plague traditional miners. When silver prices are elevated, Wheaton's margins explode because they're buying at fixed low prices and selling at market rates. Now, let's talk about what could happen next and where this market might be headed. The silver market is experiencing its 6th consecutive year of structural deficits. Global demand is exceeding mine supply by approximately 170 million ounces annually. Think about that for a moment. Every year, we're consuming more silver than we're producing. That's not sustainable indefinitely, and it creates a fundamental support level for prices. However, the picture is more nuanced than simple supply and demand. Industrial demand, which accounts for the majority of silver consumption, is expected to decline by about 2% in 2026, reaching around 650 million ounces. The primary culprit is the photovoltaic sector, where ongoing efforts to reduce silver content in solar panels through thrifting and substitution are starting to show results. But this is being partially offset by expansion in data centers, artificial intelligence technologies, and automotive applications, particularly in electric vehicles where silver's superior conductivity makes it irreplaceable in certain applications. On the investment side, physical investment demand is forecast to rise by 20% to a 3-year high of 227 million ounces. Western physical investment, which had declined for 3 consecutive years, is expected to recover. This makes sense when you consider the geopolitical landscape. Elevated tensions, uncertainty surrounding U.S. policy, and concerns about currency devaluation are driving investors toward hard assets. Silver, trading at a ratio to gold that many analysts consider historically cheap, looks particularly attractive. So what about price targets? Analyst opinions vary widely, and you should always be skeptical of extreme predictions. But here's what we're seeing. Some analysts expect silver to increase by over $100 per ounce to reach $175 or higher during 2026. More conservative estimates put year-end targets in the $75 to $90 range. Goldman Sachs and UBS remain somewhat cautious on silver compared to gold, citing supply constraints in the London market and concerns about reduced industrial demand if prices stay elevated. The Federal Reserve's policy also plays a crucial role. Markets are currently pricing in roughly 2 rate cuts for 2026. If those cuts materialize, it should provide additional support for precious metals by reducing the opportunity cost of holding non-yielding assets and potentially weakening the dollar. Conversely, if inflation proves more persistent than expected and the Fed maintains higher rates longer, that could create headwinds. Here's my take on positioning. The silver market faces competing forces right now. On one hand, we have structural supply deficits, growing awareness of silver's critical role in emerging technologies, and safe haven demand driven by global uncertainty. On the other hand, we have extreme volatility, profit-taking after a speculative surge, and potential demand reduction at these elevated price levels. The recent crash, while painful for those who bought at the peak, may have actually cleared out weak hands and excessive leverage, creating a healthier foundation for the next move. For the mining stocks we've discussed, the key factor is that they're still being valued at much lower silver prices than current market levels. This valuation gap needs to close, and when it does, these stocks could see substantial reappreciation. First Majestic offers pure silver exposure with operational momentum. Pan American provides scale, diversification, and financial strength. Wheaton delivers high-margin, low-risk exposure through their streaming model. Each serves a different purpose in a precious metals portfolio. If you're considering positions in these stocks, I'd encourage you to think about your time horizon and risk tolerance. These are volatile securities in a volatile sector. Dollar cost averaging, where you build positions gradually rather than trying to time a single perfect entry, might be worth considering. And always have a plan for managing your position, including profit targets and stop losses if things don't go as expected. The silver story isn't over. Whether we've seen the ultimate high or just a pause in a longer-term bull market remains to be seen. What we do know is that the fundamental case for silver, driven by industrial demand and investment demand, remains intact. And these 3 companies, each in their own way, are positioned to benefit if silver stabilizes at these elevated levels or continues higher. That's it for today. If you found this analysis helpful, make sure to like this video and subscribe to the channel. Drop a comment below letting me know which of these 3 stocks interest you most and why. Are you bullish or bearish on silver from here? I read every comment and love hearing your perspectives. Thanks for watching, and I'll see you in the next one.